Welcome to the Entrepreneur's Journey, the podcast where we explore how seasoned leaders and founders build strong, scalable companies. I'm your host, Peter Santry, a former Wall Street exec turned leadership team coach. Today, we're diving into the world of investment banking and entrepreneurship with Paul Janson, head of M&A, and sits on the investment committee and the board of Capstone Partners. Capstone Partners is a leading middle market investment bank that provides M&A, private capital, and financial advisory services to entrepreneurs and business owners. Paul brings a unique perspective. He's been both an operator on one side, running telecom companies, one to a successful exit and another, unfortunately, into bankruptcy. And that informs his role as an investment banker who sees hundreds of companies a year, helping only a select few make it to the market. In this episode, we'll learn what makes a company investable, how entrepreneurs can avoid common pitfalls, and the critical lessons Paul has drawn from both success and failure. So welcome to the show, Paul.
Thanks, Peter. Glad to be here.
Good. So as I said in the intro, you've been both an operator for a good part of your career and an investment banker. Can you share what you learned from selling one telecom company successfully, and then some of the issues that dogged you when you were running one that went into bankruptcy?
Sure. So selling the one successfully, I think the biggest lesson I learned, and it's what I would tell your audience, is spend a lot of time thinking about what happens to your company and even yourself personally after the sale. So sure, getting to the sale is really important, but life for your employees can change dramatically, and life for you can change dramatically. And I would tell you, you don't learn as many lessons selling it because everything went well, right? You reached the proper conclusion you wanted to reach. Negotiating with a buyer is similar in a way to negotiating with a big customer. Who has best leverage, who has the best plan of attack, if you will. And actually sold two companies successfully. Having a company end up going bankrupt taught me immensely more about how to operate and how to protect your company. We happen to have a situation I think a lot of folks fall into today where our company was doing so good, we outran our cash flow. And when one of our customers had it was a huge telecom company on the West Coast that we worked for. It was actually a public utility. They had a budgetary problem and had to cut back only for 6 months, and we didn't have the cash flow. We had so much of our assets and energy involved in that contract, we didn't have the cash flow to quickly pivot and survive that 6 months. And that's a short period of time to get bank financing, especially in light of a downturn, right? Commercial banks only want to lend you money when you're doing well. And so that lesson learned, when things are going really, really well, you need to continue to think about how can I protect my company if something unfortunate happens, and we didn't do that.
So let's break that down a little bit. It sounds like you had a overly concentrated revenue stream with a customer concentration that was, all your operations and cash flow and investment and inventory was being dedicated to that customer, and it sounds like they took a pause in terms of taking delivery, so you had a lot of capital tied up in your working capital and maybe some investments in plant and equipment or whatever as well, and then of course you had to pay all your vendors on the other side, and basically you had a mismatch where those payments were coming due and your receivables weren't getting collected, or they weren't, or they weren't being generated because the company took a pause. Is that a good summation?
Yeah, we were performing field services, think construction and maintenance, on one of the big public utility networks in California. And so we had, a few hundred people climbing telephone poles, working on underground utilities, things like that. And an immense amount of equipment. Telecom, especially working with the utilities, is equipment intensive. Huge trucks, huge boring machines, street cutting machines, all that sort of stuff. And then the teams, the employees that go along with it. when the utility had to pause both their maintenance side and their construction side, for them, 6 months is nothing. They're going to own the asset forever. So while it was going good, our margins were fantastic. We were paying people very well. We were keeping on top of our vendors. Our equipment payments, we had a couple $1 million of equipment payments annually. All of that was going good, and you could project out, and we did. Wow, if this just lasts 3 more years, we'll be out from underneath the equipment payments. Our EBITDA will continue to look really, really good. Our free cash flow, right, different from EBITDA, our free cash flow becomes fantastic. Hey, 3 more years. Well, it's hard for a great situation to survive that long and my management team and I didn't have that sort of experience set. So we didn't even see how a big public utility could give a pause. To us, 6 months was forever. To them, it was nothing. And so we didn't have any line of credit built up. Any of the sort of, we weren't necessarily conserving cash, really, really focused on conserving cash. And so when it happened, we just couldn't get bank financing, and we didn't have the amount of cash on the balance sheet to, we laid off some employees. We pivoted to less profitable business, but your fixed payments, rent on warehouses and offices and equipment, don't go away. Sort of,
Right. That
and you don't
nagging
want to be selling
overhead.
equipment at a fire sale, right? Because theoretically, 6 months later, we would have needed it. So all of those things, it's the classic story I'm sure you've seen, Peter, where you outrun your coverage through success, and you weren't smart enough and experienced enough to build in some protection, some safety net for a short-term bad thing happening.
Right. And a great lesson, and one I coach is, when things are going well, make sure that you shore up your liquidity and through a lot of measures, including getting a line of credit should you need that, build cash reserves. And then of course the customer concentration issue is always, a common business problem that you can, if something happens, you're overexposed and can't adjust quickly enough. So,
Yep.
okay.
We actually tell clients, Peter, this is different advice than they get from their tax advisors, commercial bank, whatever. A lot of businesses run the business with an eye towards not paying taxes. The problem with that is when things go bad, you haven't built up any cash cushion on your balance sheet. We actually tell people, look, bite the bullet. If you got a really profitable business, pay taxes for a few years. Don't dividend everything out. Pay taxes for a few years. Build up your cash. Then run the business with an eye towards taxes. I know your tax accountant's going to hate that, but you can run the risk by running a business from day one in a really tax efficient manner of not being able to survive some small downturn.
Right. You just don't have any cushion. Good advice. So let's move out of that chapter, which is, the operator side, and now you're financing companies, looking at them, helping do M&A and all that sort of stuff. You see hundreds of companies, people coming to you seeking capital. Probably your success rate we talked about was 1 in 10, or a company success rate in accessing the market, and 9 get thrown back and because they're not ready, or the business model has flaws in it. So what separates that 10% that allows you to take them to the market?
So just to give your listeners a little bit of context on Capstone, we have contractual referral relationships with some of the biggest wirehouses on the street. So Bank of America, Merrill Lynch, Morgan Stanley, UBS, just to name 3. When a deal isn't big enough for their huge investment banks, they send it our way, and we try to treat their clients with white glove service. So we see thousands across those funnels and our own funnels. We see, a couple of thousand businesses a year. And the single, I'd say the 2 greatest negatives that we see that cause us to turn down are, we've already talked about it a bit with my story. So customer or supplier concentration. So today, a good example would be, and it's kind of twofold, but a good example would be, we have a client who builds the coolest signs you can think of. So think, Las Vegas or New York, these huge signs in Times Square. interactive, lighting, etc., gets 100% of his diodes from China. 100% from one supplier in China. They're the most high end. He could go to Vietnam and a couple other places, but they're not nearly as high end, which would impact his business. You can't say he's doing tremendously well revenue and cash flow wise, but you can't really sell the business right now because his supplier concentration has two problems. A, it's 100%, and B, it's China. So he, eventually we'll have some sort of trade pact with China. I couldn't begin to tell you what, because it changes every day, what it's going to look like. But right now, buyers like everything else about the business, the industry he's in, his technical craft, which separates him, his cash flow, his growth is really strong. And that one singular issue, so customer or supplier concentration, and to us, it's anything over 50%. It used to be lower, but the world's getting a little better about the buying universe is getting a little bit better about customer concentration, but not to 100%. And so that's the single biggest. And then the second is just size.
That's supplier concentration, though. Weren't you saying that?
It is supplier or customer. Yep.
Or customer. Okay. Right.
And so in my personal story, it was, customer concentration, right? This is supplier, but they're equally bad. And the other one is just sheer size. It's very, very hard to sell a business outside the tech industry. Very hard to sell a business with less than 5 million of EBITDA because it's sort of a clash. Your seller, your client, wants to get a reasonably good valuation, and buyers just won't give you that at that level, because if you've got 3.5 million of EBITDA and you have one single thing go bad, you could be out of business, right? Because your free cash flow probably isn't particularly strong. So size is the second biggest issue. And then, a third one is what we call the Messiah stage. It's if a business is still in the Messiah stage, where the owner makes every decision from huge, do we reprice our product? Do we build a new factory? To what toilet paper do we buy? And the issue with that is buyers have recognized that about 80% of the time, the founder, the CEO, will leave within a year, no matter what is said and negotiated in the diligence phase. That person is going to leave 80% of the time within a year. So if the company, it might be their business relationships, their customer relationships, if any of the important aspects of the company are wholly run through one person, that's a very, very hard company to sell. So we also look for that, and that causes us to say no on occasion.
Yeah. So just over reliance on the owner, whether it's with customers, whether it be technology, whatever they're doing is, or doing everything. And that's a great lesson. And in fact, in my own coaching business, what I try to do is really take the owner and put them in one box and make sure we've created mini CEOs underneath who are handling the various areas and have autonomy around their spaces, whether it be marketing, sales, operations, so that the business is self-managing and not overly reliant on one person. And that certainly helps you get investors comfortable that there's a team there rather than just one person, let alone, geez, what could happen to that person if something bad did happen. That's the other problem.
Yeah, look, I would say this not because you've been kind enough to invite me on your podcast. That is the single best thing you could do for any of your clients, because think about it, a business never moves left to right, north to south, right, on growth in an even line. They always have a bad day, bad month, bad quarter, bad year. A really good deep management team can manage around that. A single person, it's harder, right? Because first, you're held to the level of your own intelligence, not sort of a team intellect. And second, to your point, what if they go away? That business is in real trouble. So you need a management team because it gives both your employees, frankly, but also the buying universe really comfort that they could acquire your business at an attractive multiple and manage through the ups and downs.
Yeah, exactly. So I'm curious. So you've got, you have a company that fits the size requirement. They've gotten to that 5 million of EBITDA, so they have a critical mass that the market likes. They're not going to do anything, much less than that because of, as you said, the wind blows the wrong way, and they don't have the wherewithal to stand up. So you want to have a certain amount of size and all that sort of stuff. You've got the concentrations under control. The owner or the founder or the CEO has got a team. It feels good about it. So you've got those 10%, you're taking those to market. So what happens with the other 90%? Because, it is it's a gauntlet, and, most don't make it. So what's your advice when you turn somebody away and say, you're not ready yet? What do you do, or what advice do you give them so that they can come back in a year or two, and access the market again, or try again?
I love the question because you're going to allow me to give a small plug to Capstone because of the answer. So one of the ways we're a little bit different is we, especially when we are referred a client as opposed to finding our own ecosystem, we will talk to that client and explain to them, in our opinion, right? Not always right, but in our opinion, what they need to go away and do to have a successful exit. And we'll literally give them, it's usually verbal on the phone with one of my managing directors who is conversant in that space. All of Capstone's managing directors are industry centric experts, if you will, from the investment bank side. We have no generalists here. And they will sit down with that client and say, here are the 3 things we think you need to do to improve. And take your time, next year or 2, right? They can't be done tomorrow. Is it build up the management team? Is it come up with a much better growth strategy, fix your manufacturing processes? You have too much waste, whatever the case may be. We'll explain what the buying universe values. So value enhancers to your business that you need to go away and strengthen or create. And then we hope they come back to us. But I would say, 50% of them probably succeed someday with an exit. They go away and do it. And 50% don't, right? They hear you, but it's hard work. And in that moment, the founder is clipping, $500,000 a year out of his or her business, and they're pretty happy with that. And that's okay too. We've seen plenty of businesses. I have friends who operate businesses doing 5 to 10 million a year in revenue, $1 million a year in earnings, and it's a great living for them. The problem is, in this country, statistic, I'm going to get directionally correct. I don't know if I'll have it exact. Only about 5% of businesses go to second generation, and only about 1% go to third, because unlike Europe or Asia or the Middle East, younger folks in this country have a wealth of options to them. They don't have to go into their family business. And so if you care about your employees, you sort of need to think about the next chapter someday, because you're going to be 65 years old and look to retire.
Yeah, yeah, totally agreed, and good advice. And I think candidly, this is a hole in the market, and I see, the sort of spurned, company that's looking to raise capital or exit or whatever. Sometimes there just isn't a safety net, and it's something, and with my practice I'm trying to address. It's like, let's get you investable, let's make you more valuable, and let's put those things in place before you go to the investment bank. And I'm trying to convince people like yourselves to think about referring that into somebody who can help them do that, because it really needs to be a facilitated process. You know how hard it is to work outside of the performance of your business, but to get stuff in your business is difficult to do without sometimes outside advice to help you get there. And not to plug coaching, but that's certainly something that I try to do. So
Look, Peter, I'll give you an example of how you can help businesses that you do every day, as a matter of fact. So I sit on the board of directors of a wireless telecom company.
mm-hmm.
We're looking at a very small acquisition, 2.5 million of EBITDA. And we had a call with the company yesterday. The CEO, the lower middle market investment banker, put us on with the CEO and his management team. And we got to question about growth, and they didn't have any sort of answer, any sort of good answer. And it caused us to revise our bid. So the average multiple today in the US is around 8.5 times, right? Some industries higher, some a little bit lower. Think about that, 8.5 times EBITDA. Our bid is going to be 2.2 times. It's small, 3 million. There aren't many other bidders. We know that. If we lose it, fine. That's fine. It's not game changing. And they have no answer for growth, which means we're not really looking at a business going from 2.5 million of EBITDA, and they've got a really good growth plan. It might go to 5 million in itself. It's probably going to stay at 2.5 million. So we're just buying cash flow. So business owners should think about that valuation gap. 8.5 times is the average multiple. And this is just one data point for you, but they were badly coached. The management team was badly coached, hadn't put enough thought into a key valuation driver. And, our bid's going to be 2.2 times.
Yeah. Yeah. Both for the size and for the lack of a vision and a plan to get there. That's much bigger. Yes. And that's certainly part of our process. I just want to hone in on one area that's obviously hugely topical, which is AI, and how that is creeping into the buyers, sort of calculus as they look at a business. And is there an AI readiness or AI sort of opportunity that people are starting to build into their analysis these days? And what should business owners do to prepare in that regard?
So first, let's answer the question maybe backwards. Before you start to think about how AI can improve the efficiency at your business, you have to think about, could AI replace your business? Start there. If you're pretty sure the answer is no, go to the next step, right? Can it improve my business? And that would be a natural order. But I'll give you a couple of industries that I think are going to disappear. Not the service. So one would be digital marketing. Pretty soon, you'll the head of marketing at Keurig Coffee will be able to have an AI engine that works for him 24/7, looking at how their programs do, and he can just decide what he wants to do, tell it to that engine. So the digital marketing services companies out there are going to have to dramatically change or disappear. I'll give you another one, call service companies. So there's a large telecom provider in the US that recently they've been developing AI call center agents for a long time, like way before the buzz, because it takes a while. They recently ran a test of 10,000 live phone calls with their AI agent and 10,000 with live agents. The AI agent answered about 80% of the questions successfully and got a higher quality rating from customers. Because think about it, we've all yelled at our telecom providers at one time or another. Well, an AI agent doesn't get mad back at you, doesn't hang up on you, doesn't get frustrated with you, and cause you to become more frustrated, right? They just respond. And it's not a high enough success rate for this telecom company to let go any agents, but you can see a year or two from now, when they get above 90%, they will get rid. They use 300,000 third-party call center agents today. They will let go all of those companies, bring the 10% of calls they need to answer in-house, and use AI agents for the rest. So call centers are at risk if they can't. I've talked to owners of call centers who say, man, AI agents are going to make my business so much more profitable. No, you're going to get disintermediated because the client, if they're big enough. So got a brilliant call center operator that's only taking business from smaller businesses because they probably aren't going to ever have the cash and the acumen to do it themselves. But your huge third-party call center operators are going to be massively negatively impacted. So again, think about, can it replace your business down the road, period? And if you don't think it can, then think about how AI can help your business.
Yeah. And I would think answering the first question and then moving to the second, and then coming to the process, coming to you, coming to the investors with, this is how I am using it to help my business, is probably a plus and shows the foresight that an investor team would want to see in terms of a management team, addressing that issue head on. And coincidentally, in a prior podcast, I did have a head of an answering service company on the podcast, and she does, just as you said, AI is affecting them, and she does cater to that small middle market business service that is never going to really bring that stuff in house, and does want to have a human at the end of the line. So it's I think they're nicely insulated from the extinction problem that you mentioned. But obviously a big thing that she's grappling with, and we got into on the call. So good. So let's tack away. You have your own sort of entrepreneurial sales story yourself at Capstone, where you grew as an independent investment bank, kind of born out of the financial crisis and the wealth of experienced bankers that were available, that you formed the Capstone under. And then you made the move to, or were, I guess, approached by Huntington Bank shares, and you struck a deal. And tell me how you've been able to preserve your entrepreneurial sort of culture around the business that you have preserved, being part of a larger financial institution like Huntington.
So, for your, again, listeners, from a historical perspective, the number of times a large commercial bank bought an investment bank, especially a middle market investment bank, and didn't destroy it internally, is pretty much the null set. I can't sit here and give you an example of when it worked well, and I think we might be the first one. Our CEO, John Ferrara, he's our founder. He recognized that on the front end. And we were actually in the market raising $100 million to buy another like-sized investment bank. That's what we were doing. We were going to take on probably a private equity partner. And we were approached by Huntington Bank out of Columbus about the possibility of acquiring us. They have a phenomenal service offering, but their private wealth clients and their commercial banking clients, they could not offer them investment banking services. And so it was sort of a meeting of the minds. They recognized the same thing historically that we did, that traditionally big commercial banks end up wrecking their investment banking divisions. So on the front end, John was smart enough to negotiate things like, we get to keep our brand, period. Not we get to keep our brand for 24 months. We have a completely separate board of directors. Our entire management team, almost 3.5 years later, is still here, stayed because of that independence. They took over from us things that, frankly, even though we have around 270, 280 employees, we couldn't do tremendously well. So compliance and legal. The bigger bank took those over for us, which is fantastic. They have all sorts of people on staff that think about that stuff every day, and we only thought about it when it was a problem. We've delivered to Huntington a lot of new business for them. Conversely, they've delivered even more new business for us, and so. And they've left us with just an enormous amount of independence, and it works really well so far both ways. So, if I was a year into this, I'd be talking out of my hat, because who knows if it would work or not. But 3.5 years into it, I'm telling you, I actually believe, I'm still here, I actually believe this is going to be the first time ever that it has worked with a commercial bank buying an investment bank.
Excellent. And having been through many of these myself in my prior life as an investment banker and capital markets and sales and trading person, your perspective is exactly right. The culture gets crushed, the people leave, the value dissipates, and you wonder why you did it in the first place. So 24 months later. So that's great. So tacking back again. So to the audience members who are CEOs, founders, if they're thinking of an exit or raising capital, what's the single most important thing they should start doing today as they think down the road towards a capital raise or an exit?
So accountants out there are going to be wildly happy with this answer. First, get some advice. Again, I'll plug investment banks. Try to find an investment banker or a business advisor yourself, for example, who can give you some things to fix before you go to market, because you don't want to fix them while you're in market. So but the single thing they can do on their own is to get a reasonably good size accounting firm. So a lot of small businesses have, they're with a 4-person accounting firm and they do maybe reviewed financials every year. You don't have to go with one of the big 4, but get a fairly large regional accounting firm to come in and do what's called a quality of earnings report. And the reason is it will show you things about your own company, mostly from a financial seat, that you have to get fixed. I'll give you an example. And this isn't a small company. We're taking a company to market that's doing about 120 million of revenue and about 15 million of EBITDA. And we have them doing a quality of earnings report before we go to market. And which is what we do with every company we take to market. Generally, they get the Q of E done. It doesn't show huge issues, and we take the company to market right after that. It confirms their revenue and EBITDA is being recognized correctly. In this instance, the Q of E discovered that the company's project level accounting system was not accurately talking to their corporate level accounting system, which meant you couldn't reconcile numbers. And can you imagine, in the middle of a process, buyers would, of course, they do their own Q of E. The final buyer does their own Q of E. They discover that calls into question your entire financial accounting system. The entire system, they were stunned. Like, they didn't even know it was happening. They're growing so fast that, sometimes companies grow so fast, they leave operational principles to the last thing to sort of clean up. So they have to go clean this up, not only today, which they're in the process of doing this week. They've got to clean their books up going back a minimum of 2 years. So we've delayed the process. We were going to launch their calling effort next week. We've now delayed it till middle of to the end of January.
Right.
So
right.
The single thing, based on how you pose the question, the single thing I would tell any company of substance to do a year before is to get a quality of earnings report done so that you can fix it. And it may find nothing, but you're going to have to do that before you go to market anyway. So it's not a waste of time. And updating those is very inexpensive. The original one's expensive, but updating them is $20,000 or $30,000. Is the single thing I would recommend that folks go do.
Yeah, you can't show up with a grocery bag full of receipts and expect to get a nice valuation out of that. So very good advice. Okay. Well, thanks, Paul. If somebody listening to this call wants to learn more or engage with you and Capstone, what is the best way for them to get a hold of you and your company?
So just our website, capstonepartners.com. They'd be able to find all my contact information. More importantly, I've got 45 managing directors, 15 or so directors, and their industry verticals are all listed on our website, along with, of course, each person's contact information, email and phone number. And not that I wouldn't be happy to hear from all your listeners, but you can bypass me. If you need to talk about healthcare, it's Eric Williams. If you need to talk about tech, it's Dave Michaels, etc. So you don't even have to worry just about calling Paul Janson. There's a wealth of folks on there. We also have 140 research reports that we publish every year. So you can go in and sign up for the ones in your industry, not all 140, of course. And that would be helpful to a business owner as well.
Okay. Well, thank you. Thank you for joining us and helping our audience learn what makes a company investable. And thanks to the audience for listening. And we will see you next time on the Entrepreneur's Journey.
Thanks, Peter.
Paul. See you.
Bye-bye.